What's up, everybody? Starting in 2 minutes. If you're here early, I commend you. But we're starting in 2 minutes. Starting in 2 minutes. Oh, I think the picture's terrible. Sorry if it's pixelated. The picture's terrible. I apologize in advance. Start in 2 minutes. All right, 1 minute. 1 minute. How about a little music? Hopefully it doesn't freeze on you. All right, 2 o'clock. 2 o'clock. If you're here, thanks for showing up. I appreciate it. I'm Thatcher Taylor, owner of ProPath Financial, registered investment advisor here in Arizona. We are going to do a 2022 market recap. A 2022 market recap for the month of January. Essentially, we're going to do 3 separate things. We're going to do a quick market recap about January 2022. We're going to hash it out. Quick therapy session. We're going to hash it out and we're going to move on. That's it. We're done. Then we're going to talk about 4 behaviors. So there's something out there in the world called behavioral finance. It's actually the study of investment behaviors for investors. It's gaining a lot of prominence on how people make decisions and how people are successful with their investments. We're going to talk about 4 behaviors that relate to what's going on right now. And then where do we go from here? If you have any questions, hopefully you can comment. I'll try to answer them to the best of my ability. Full disclosure, this is laissez-faire. This is relaxed. I know a lot of people are on traditional market recaps, Zooms, webinars, whatever. And it's kind of like uptight. Just relax, kick back. So it's 2 o'clock here in the great state of Arizona, or Mountain Time. If you're on the East Coast, it's 4 o'clock. For some of you, it's happy hour. Happy hour on a Tuesday. So you want to just relax, enjoy the show. That's what we're looking for. So market recap. Let's go here first. VOO for year to date. VOO is the S&P 500 index. It's probably the most prominent benchmark that we have that people utilize. VOO so far year to date is down 4.61%, but that includes today. So if we were to go to yesterday, January 31st, it was down 5.24%. So from the beginning of the year, you had a couple good days over here. Like, oh yeah, everything's fine. Happy New Year. And then it really struggled. The purple is Vanguard's total international stock. So it's just a broad bundle of all international stocks. It's not very sector specific. It just owns everything. This up to this point, it's at negative 2% on the year, which is not uncommon, to be honest with you. When you look back, I think 50 years, almost half the years over that 50-year period, international stocks have outperformed domestic stocks. That's part of the case for international, having that in your portfolio, that type of exposure. But it's important to note that having a little diversification can be valuable to smooth out the volatility, the swings in the portfolio. If you had a little bit of both, your portfolio wouldn't be down 4.61%. Something I get a lot all the time. My clients reach out to me and say, "Hey man, what's going on? The S&P 500 is down X amount and my portfolio is down X amount, or the S&P 500 is up X amount and my portfolio is only up X amount." Unless you own everything that's in the S&P 500, you're not going to exactly mimic the S&P 500. That's correlation. That's a whole nother discussion. So something I thought would be valuable is actually looking at what's in the S&P 500. When was the last time you went and looked at what's in the S&P 500? So check this out. This is really interesting. So the S&P 500 is the essentially 70-80% of the total US stock market capitalization. Capitalization means shares outstanding times the market price. So if you look at the market cap of the company, you look at the shares outstanding times its stock price, and that's its market cap. This is the most commonly used benchmark, like I mentioned, but look at all these stocks. So when you're looking at the S&P 500, it's broadly diversified. It's all equities, but it's diversified amongst different company types, different sectors, different industries. So you're getting a lot of diversification from an equity standpoint within the S&P 500 itself. That's why I was using VOO as an example. It's just an opportunity where you can buy the S&P 500 ETF from Vanguard. That is not a recommendation. I'm just using it as an example. But check out some of these companies. This is really interesting. Apple, obviously, Microsoft, Amazon, Alphabet, Tesla, Alphabet Class C, which we'll get back to that here in just a second. Meta or Facebook, Berkshire Hathaway, Johnson & Johnson, Exxon, Chevron, Pepsi, Comcast, Verizon, Wells Fargo. We got banks, we got tech, we got consumer goods, consumer staples, McDonald's, Nike, AT&T. Let's see what else. BlackRock's at 69, Boeing, Caterpillar, GE, Intuitive Surgical's at 82, Stryker, Ford. Everything that everyone's buying is built up in here. But let's kind of go down. I want to show everyone something. Did you actually know, fun fact, 505 stocks are in the S&P 500. The reason is because there's some double share classes. Like I mentioned up here at the very beginning, Alphabet Class A and Alphabet Class C, there are multiple securities within the S&P 500 that their different share classes are built in. So that was just kind of a fun fact. But this is a highly diversified exposure to our market, and it's 70 to 80% of our total US stock market capitalization because it's market weighted. Apple and Microsoft and Amazon, because they're so big, their market cap's so big, it outweighs a lot of the rest of the securities. So this is the S&P 500. It sucked the past month. Let's go back. It sucked the past month. But honestly, who cares? Look at this. 10 years. It just gets lost in the shuffle. It's kind of up here in this blip. It can be a significant blip, but it's just up here in the blip. Over a 10-year period, 5-year period, the blips get a little bit bigger. But when you're looking at small windows of time, you see all that volatility. So you really need to get perspective about how you're investing, which is one of the behaviors we'll get to in a little bit. So international performed a little bit better, but it's more broadly diversified. These are just examples. Okay. Next thing, inflation. Inflation can be scary to some people. In fact, it's probably the biggest talking point that you hear everywhere. Let's look at the different categories of inflation. So there are different categories. All items is kind of the average. This is the Bureau of Labor Statistics. So it kind of breaks everything down into categories. All items right in the middle, the average is 7% from December 2020 to December 2021. That's substantial. That's not anything to balk at. And you can see that just everywhere. But here's some of the biggest categories you're going to see it the most. Gas. We heard a lot about gas. Used car and trucks. It's crazy that my vehicles that I own are worth more now than when I bought them years ago. It's crazy. Energy, utility, meats, poultry, fish, and eggs. Absolutely. You want to buy a steak? Good luck. You better be willing to pay for it. New vehicles aren't inflating as much as used cars, tobacco, and smoking. One thing that I want to scroll all the way down to is shelter. This is interesting. If anybody else has any more input, please let me know. Here, hang on. I hope I don't know if people are commenting. Let's see. I'm not seeing any comments. I don't even know if anybody is commenting. But anyway, shelter 4.1% over the past year. Now I know this was a January 2022 market recap, but this isn't updated yet. But you can see that shelter says 4%. I live in Arizona. If you're living in Arizona, I feel like Idaho, Texas, Florida, maybe Georgia, the Carolinas, Tennessee, the boost in housing costs, the ability to purchase a house is definitely skyrocketed and inflated way more than 4%. I thought I read somewhere it's like close to 25% in some areas. And they're expecting maybe an additional, depending on where you're at, 22% if you're buying houses. I can feel it in my personal life. Trying to buy a house in Arizona is such an obnoxious headache. But inflation is what it is. Inflation potentially, you'll see a correlation with the performance in the market if inflation continues. So it's just something to be aware of as we move through this. One thing I wanted to look at though, going back to the S&P 500 that we mentioned here, its current performance and its volatility. One of the behaviors we're going to talk about a little bit is essentially being fearful and having a lot of emotion in the market. So the market does its thing, you get scared, you sell out. People that have a lot of emotion look at the market in short windows of time. A rolling 1-year return for the S&P 500, thanks Fisher Investments for this, they just did a better job of it. A rolling 1-year return. So a rolling return is on January 1st of 2022. That starts a rolling 1 year. And then on January 1st, 2023, that's a rolling 1 year, but also it starts a rolling 5-year, a rolling 10-year, and a rolling 20-year, and a rolling 25-year. On about 74.7% of the time, you've had a positive gain in the S&P 500 in a rolling 1 year. And this is over a long period of time. Okay. This is from 1928. This went to 2017, but this would be very close to what it is now. A rolling 5-year, you make money 87% of the time. A rolling 10-year, 94% of the time. And a rolling 20-year. So far, up to this point in our existence of the stock market, if you invested your money in the S&P 500 for 20 years, every single year, that money would be worth more in 20 years from that rolling period. This helps us understand that we can take what's happened so far and just forget it. Forget it. Don't worry about it. In addition, what we can take moving forward is if the market has some more bumpy months, just don't worry. Don't worry. Statistically, it's in your favor. And unless all 500 of these companies go kaput, if you invest in a diversified holding of this, it's not going to go kaput either. That's why the performance in a diversified bundle of stocks can sometimes be better than trying to buy individual stocks on your own. Sound good? Inflation is going to be what it is. We are literally under the control of the Federal Reserve. Whether or not they start to activate or they start to change quantitative easing, right now they've been buying up trillions of bonds to put cash into the economy and keep interest rates low. They've said that over the next year, they're probably going to increase rates 4 times. Who knows? But whatever they do is whatever they do. So we're going to talk a little bit more about how to react to that. But right now, just know, do not immerse yourself emotionally in interest rates because you have no control. It's out of your control. The Federal Reserve is in control of that, which is unfortunate, but it is what it is. Sound good? All right. Oh, here we go. Finally, a question. Let's answer a question. Corey, curious what you think about Fed stopping quantitative easing, how that impacts both portfolio and other considerations. Good question. Yeah, I kind of just discussed that a little bit. It's safe to assume a lot of times historically in inflationary environments have a correlation with an increase in prices in the markets as well. Now, as you can see, if as we go back to these industries right here, they're all a little bit different. And so let's go back to our inflationary chart. You can see all these segments have different levels of inflation. So when we look at the market as a whole, it may uplift the whole market, but different segments of the market are going to react a little bit differently. Over the past 10 years, and the inflation environment that we've been in has been low, but it's really boosted up lately, obviously. It's safe to assume the market could increase, but to be honest with you, no one knows. That's why everyone's freaking out. That's why in January everyone overreacted. People were selling, and when people saw other people selling, other more people started to sell, and that's what happens in a sell-off. People want to take their gains and run. So safe to assume the market's going to continue to grow, but that's only thinking in a small period of time over the next year or two. I want you to understand that you think longer out. 10, 15, 20 years, we're going to look back in 2022 in the inflationary environment. It's not going to really matter. There's going to be a whole new bag of issues. So don't worry too much. Just stick to your plan, which we'll discuss. Good question. All right. Let's go back to here. All right. So, four behaviors. Behavioral finance, like I mentioned, is a really important topic. It's actually starting to study the behaviors of investors and why. And when you look at large groups of individuals, you can start to see reasons why they make the decisions that they do. I just wanted to focus on four. There's a lot of them, there's a whole list of them, but I just wanted to focus on four behaviors or four biases that happen in the investing world. And I think I chose these ones specifically because it's relevant to our specific situation where we're seeing really high inflation, astronomical housing prices, and the stock market fluctuating. And it's not just been fluctuating this month. If you look back to last year, the fourth quarter of 2021, it was in a really tough place. People were really overreacting. But at the end of the year, it's unusual because people really want to calm down. They just start spending more money. But what happens simultaneously is people start selling RMDs or assets to meet required minimum distributions or rebalancing or tax loss harvesting or whatever they're doing. So it causes a lot of fluctuation. But those are strategies that are required by the IRS or within your portfolio. I shouldn't say required. Those are strategies that are implemented based on the IRS, if it's a required minimum distribution, or if your advisor's helping you with those things. So it's part of a strategy. What I'm talking about are people selling off just out of their own intuition. First one is overconfidence. Investors are usually overconfident in their ability to time the market. They're especially overconfident in their ability to evaluate investments. Let me give you an example. Let's look at something really quickly. I love going to this. I'll share my screen in just a second. Let me get this pulled up. All right, let me show this. Hang on, hang on. I'm trying to get the speed report. It's loading. It's loading. Got to accept cookies. Am I the only one that's driving crazy? Is got to accept cookies? Every website's got cookies. All right, let me show you this. All right, this is the speed report. 82.51% of actively managed large cap funds underperform the S&P 500. So here's the reason why I'm telling you this. Individual investors are overconfident in being able to choose investments for their portfolio for a couple of reasons. One, they don't look at time, like I mentioned before. They sell and trade immediately, usually in very short periods of time based on emotion. But two, comparatively to the big time investors, institutional investors, mutual funds, they got the smartest people with all the financing that you think that they would need, with all the tools that they have at their disposal, all the research departments. 82.51% of them underperform the SP 500 over 10 years. So why do we think as individual investors we can outperform the SP 500 by picking individual securities when the best of the best struggle to do it? So there's something that I want to show that I thought was really interesting. If I can find it here. This is essentially the cycle of how people's behaviors take over. You can see at the peak, right here at the top, overconfidence, one of the biases that we just discussed. But what happens is overconfidence leads to, oh, you're surprised. Oh, okay. My investment didn't work the way that I thought it did. As it continues to drop, you get nervous. Then you panic. Then you become defeated. Then you sell. So your overconfidence turns to fear and you lead to selling. That's what's happening, or what is being set up right now in our marketplace with the markets at all-time highs. So you start asking yourself the question, if I'm overconfident, what am I using to choose my investments? But two, when the market doesn't do what you think it will, what are you going to do next? That's the big question. So I think you need to start coming up with that answer to evaluate your overconfidence bias and becoming a little bit more realistic about what you're doing. The next bias we want to go to, self-serving bias. Now, self-serving bias is cut from the same cloth when it comes to overconfidence bias. Overconfidence bias is kind of what you think about, like, I got it all figured out. I got it all figured out, but I'm going to tell the world that I got it all figured out, if that makes sense. Self-serving bias, it basically means that you attribute all of the good outcomes to your skill, but all the bad outcomes are because of bad luck. So you start to reframe the outcomes based on what's going to serve your emotions the best. So if things go right, oh, you're really, really smart. You made all the right decisions and you're really confident, or sometimes overconfident. But if things went bad, it was just bad luck. It was the Fed's fault. It was Lehman Brothers' fault. It was all those faulty loans in 2008, 2009. It was all their fault that destroyed my portfolio. You need to be careful when it comes to accepting responsibility to the things you actually had an impact on and the things you didn't. That bias leads to you making poor decisions around your investment portfolio at inopportune times. So really be aware of what you're looking at when it comes to the ability to reframe what you actually did and impacted your portfolio. Loss aversion, this is really simple. People are so much more concerned with how much they lost and how much they made. A client's portfolio could make 5% over the course of a 30-day period, and I won't hear a peep. But a client's portfolio could lose 3% over a 10-day period, and they will blow up my phone concerned about their portfolio. The reason is expectations are it's supposed to make money. It's not supposed to lose money. People always want to make everything that the market will provide for them, but they never want to lose as much as the market does. So you need to make sure that you understand with loss aversion that you need to be willing to accept a certain level of risk. A certain level of risk gets you a certain amount of gain, but you're going to have short-term, in theory, short-term losses along the way. So you really need to be able to think conceptually about the value of the growth over long periods of time. We can actually, again, show this chart here. The 1 year, these periods of time in the SP 500, people are more concerned about these losses, but when you stretch out the window of time, those small losses become less relevant. So loss aversion, losses need to be accepted in some capacity. And we've talked about this with a lot of my clients where the market being down has provided some opportunities. Roth conversions potentially could be a good thing in a down market, and tax loss harvesting could potentially be a good thing in a down market, especially with how our investing world is set up. It's very easy for advisors and clients to sell things off and buy new things. Consult with your CPA and advisor, obviously, but being aware of losses and not being scared of them is really important. All right, moving on. Last one, my favorite, herd mentality, doing what the herd does. Warren Buffett, I don't remember the quote exactly. When people are most greedy, be fearful. When people are least greedy, or when people are, I don't know. I can't remember the quotes. Forget I even said that. In fact, let's look it up. Hang on. Let's look it up. Let's look it up. Let's look it up. Let's get it accurate on the fly. Fearful when others are greedy and greedy when others are fearful. I was close. I was so close. It's because I was live. Because I was live. That's why. This isn't to say that every single decision you make should be opposite of what you think the herd is doing. It's very hard to get a depiction of what the large market is doing. But in general, herd mentality can lead you to making bad short term decisions that affect your long term goals. Buying things you shouldn't be buying just because everyone else is buying. We saw this in 2020 and 2021 when everyone was buying crypto and Bitcoin and investing a lot in the market, AMC trading and GameStop. That all happened because people on Reddit forums and in the public caught wind of that and started doing it because they wanted to be a part of the herd. Be careful of that because it guides you in making poor decision based on your goals. These are four behaviors. Anyone individually could be detrimental, but you can see the overlap in a lot of these as you go through it. The best recommendation that advisors can make is coaching you in developing a good strategy with your investments, developing a great allocation based on your risk and your goals, and continue with that strategy regardless of what's going on in the marketplace. That's the best thing you can do. What that strategy looks like, that asset allocation, that risk is different for everybody, but that's the best thing you can do to adapt to a fluctuating marketplace. So, where do we go from here? A really good question. Where do we go from here? The first thing we got to do is everything we discussed: inflation, stocks, just let it go. Whatever's happened up to this point, can't change it, doesn't matter. We only got to evaluate it moving forward. Past performance isn't indicative of future results. We can use history as a guide, but you never really know what's going to happen, especially tomorrow. Markets closed today, have no idea how it's going to open tomorrow. No one knows. It's just a guess. They're trying to get lucky. They're just guessing. So let it go. There's another behavior called recency bias where a lot of people make decisions off what has happened in the recent future. I don't know. We don't know. Just move forward, stick to the strategy. Look to your plan. If you don't have one, you need one, you got to get one. A plan specifically evaluates your life, what you want your life to look like, takes all of these assumptions: inflation, market returns, deflation, disinflation, everything, and it tucks it all in there. And so it gives you a roadmap on how to get to your goals and what decisions need to be made along the way. For example, if you're retiring in 5 years, it may not be the best for you to be invested in all stocks. Maybe you do if you have some great income that pays for your life, but maybe it's not the best idea to be in all stocks. In addition, if you're young and you're trying to accumulate wealth for retirement, maybe it's not the best idea to be all in bonds because you're too scared of the market and the fluctuation that we discussed. Manage your spending plan for volatility. If you have money invested, and that money is something you're going to need in the short term, it probably shouldn't be invested. This is what happened in 2008 and 2009 is the market collapsed and people needed money to protect themselves in the event of that catastrophe, job loss, house loss, whatever, and they had to sell off assets that are worth less. That depletes your portfolio so far it's hard to rebound. You need to manage your spending plan so that you have money sitting aside that you can utilize in the event of catastrophe. I know. Banks are paying hardly nothing. I get it. Even high yield savings accounts are hardly paying anything. But you need to be aware that that's the cost of protection. Now, don't put it all in cash, just enough to protect you. The rest needs to get invested based on your goals. Evaluate your assets and your allocation. This is a rebalance and opportunity. A lot of things outperform and a lot of things underperform, but a good portfolio built on asset allocation should be based on your goals and your risk. If things outperform and some underperform, you're getting too far out of that allocation, which incorporates too much risk, which puts you out of that equivalency of risk to goals. You need to make sure that you rebalance and back to your stated risk tolerance, and asset allocation could be really valuable for you. Assess how it's not you, assess how you invest and your trading strategy. Something we've discussed, all these behaviors. You need to assess when the market does something that you didn't expect. What are you going to do? You need to have a strategy in place. A lot of times it's do nothing. Sometimes it's do something based on your strategy, but a lot of times it's do nothing. Lastly, ignore the media, find trusted advisors. Simple. Obviously, ignore the media, find some trusted people that you can talk to and speak to, whether it's an advisor, sometimes it's a CPA, but they're usually tax specific. But a lot of stuff we're talking about is investing, maybe get an advisor, someone that you can talk through some things with. Really important. Got a bug flying, a visitor, an unwanted guest. Make sure you have plans in place to protect you. The only time you sell in volatile markets is when your emotions come into play and you get hectic. You do not want to panic sell. You want to sell only when it applies to your strategy. Buy low, sell high, not sell low, buy high. If you want to chat more, this is just the first one. So this is a January market cap. We talked about the market. It was a struggle bus. Who knows what will happen next month? Forget it. We talked about interest rates or inflation. I'm sorry. It's still increasing. It's about 7% right now. It's ugly. We don't love it. So things that you're buying now are going to be more expensive here in a month, maybe by a little bit, depending on the category. But be aware that they're going to be more expensive. You need to make sure that your behaviors are in place. If you need to reach out to me, I'll chat with you anytime. Instagram, catch me Dad Bod Financial. I love fitness. It's a little fitness flair on there. YouTube, go to YouTube right now. Thatcher Taylor, hit subscribe. LinkedIn, connect with me, follow me, message me. I'm happy to help out. Facebook as well. Reach out to me on Facebook if you're catching this there. My website is propathfinancial.com, and the blog website is thebuildingwealthblog.com. Reach out to me. The blog's got some good information. Let me know if you have any questions. Let's see, Scott Wyatt. I've got to run, but thank you. Love it, Scott. Thanks for watching. I appreciate it. Before I go, are there any more questions? I'll wait for a couple minutes. Are there any more questions? I just kind of ramble and hunt around. Man, let's see what happened in today's markets. Let's kick it over. Maybe you can see this. Industrials, that's the Dow Jones, doing a little bit better than the S&P 500. While I wait for some questions, I'll stay on for about another 5 minutes while I wait for questions. The Dow Jones is only 30. S&P 500 is 500 company. Dow Jones is only 30-ish. So it kind of depends. That's a prime example of how the segments are performing. Tips this year, man, tips. Tips are supposed to increase. They're supposed to go up with inflation. The Russell 2000, so we're breaking out of the 500. The Russell gets extended out past the S&P 500 to some smaller market cap companies. It's really struggling. Some of those small companies are really struggling. You can see how the S&P 500, although it's been struggling this year, it's really been uplifted by the larger companies, the FANG stocks, Facebook, Alphabet, Apple, Microsoft. Who else? Who else are the FANG stocks? But anyway, those ones have been really carrying the load. NDX, the NASDAQ 100, NASDAQ, tech stocks, down 8.12%. But I mean, what do you expect? Let's check this out. NDX, NASDAQ 100. Over 10 years, look at how far the NASDAQ has outperformed. Yeah, it's down right now, but there's far more swings in the volatility of those tech stocks. But the past 10 years, they've outperformed. I don't know how they're going to perform in the future. Growth companies or tech stocks struggle in rising interest rate environments. So I don't know how they're going to perform, but it's just a way to look at to gain excess return. You got to be willing to assume excess risk, which means you're going to have a further downside slide. You just got to be careful of that. What else is going on? Any other questions? Nothing? Oh, let me get on Facebook. Hang on. Let me see. See if there are any questions on Facebook. There may be questions on Instagram too. I can't see it. The phone's over there. I got nothing yet. Sorry. I'm sorry if I don't see your videos. Or I'm sorry if I don't see your questions. If you're asking questions and I don't see them because I'm a dummy sometimes. If you're asking questions and I don't see them because I'm a dummy, reach out to me. Send an email. Send an email, Thatcher@propathfinancial.com, or message me on any one of these. You can message me, propathfinancial.com. You can connect with me on Instagram, YouTube, LinkedIn, Facebook, whatever. Shoot me a message. Hit me with an email, Thatcher@propathfinancial.com. Thatcher@propathfinancial.com. All right. That's all for now. I don't see any other questions. Thanks for watching. I'm going to be here. I'm going to be here March 1st for the February recap. This was just number one. So if it's clunky, sorry. We'll try to get better. Let me know how I can be better. Like, subscribe. Appreciate all of you. See ya.